everyone. Next module, INDAS or IFRS compliant financial statements of companies. Right now we have discussed about various aspects with regard to companies, how the shares are issued, how the debentures are dealt, and what are the standards that are followed by companies incorporated in India. So in this module we are going to discuss how the financial statements of a companies are prepared, why these has to be prepared. We all know that every company prepares the financial statement to identify whether the organization is earning sufficient profit or loss. Not only that, it also want to know the position of the business. So in order to identify the profit or loss, we can simply say performance. If there is profit, it will be considered as a good performance. If the company is earning loss, then we can say they are performing in a bad form. So profit and loss reflects performance of the concern, whereas balance sheet reflects the position of the concern. So every company prepare financial statements with the objective of identifying the performance as well as position. And apart from all these requirements, first and the foremost need is to comply with the Companies Act, because whatever the nature of the company, whether it is incorporated in India or not, it should follow as per the Companies Act. And Companies Act specifically mentioned that every company must present their financial statements regularly. That means the preparation of financial statement is statutory as per the Companies Act. So in this module we are going to discuss how the financial statement of the company is prepared. We know that financial statement comprises of trading, profit and loss, and balance sheet. But actually the financial statement of a concern or a company consists of more than that. And as per the INDAS, there are 5 set of statements, and apart from that there are certain notes and additional information that has to be presented along with the financial statement. Anyway, in this module we will discuss in detail how the financial statements of a companies are prepared. Financial statement is not a single statement or an account, it is a combination of different statements. So in this module we will study in detail what are the statements that has to be prepared from the INDAS point of view for the companies in India. Meaning of INDAS 1, that means presentation of financial statement. And since our standards are in convergence with the international standards, presentation of financial statement is also stated in IAS 1, that is International Accounting Standards. So INDAS 1 means presentation of financial statement, that is what are the procedures and steps that has to be followed by a corporate concern while presenting their financial statement. That is the content of INDAS 1. So as per the INDAS 1, every company has to present the financial statement as per the rules and regulations specified in the standard. As per section 128 of Companies Act, every company shall prepare and keep the financial statements at its registered office. The company must keep the books of accounts and other relevant papers in electronic mode in their offices. And every company who is maintaining the financial statement should keep in mind that the financial statements or books of accounts of company relating to a period of not less than 8 financial years immediately preceding a financial year shall be kept in their office. So these are the basic aspects with regard to the preparation and presentation of financial statement. Every company must prepare the financial statement compulsorily, because it is a mandatory aspect, and it should be kept at the registered office. If there is registered office, it should be kept at all time. If there is corresponding branches or any franchises along with it, its books should also be kept at their concerned offices. It should be kept correctly and it should represent true and fair present of the activities of the concern. So these are with regard to the general aspects of presentation or preparation of financial statements. So let us come to the INDAS point of view. INDAS 1, we can simply say Indian Accounting Standard 1 describes the framework for the presentation of financial statement. It harmonizes the accounting standards with the Schedule 3 of the Companies Act of 2013. It sets out overall requirement for the presentation of financial statements and minimum requirement for their content. This standard, that is INDAS 1, prescribes the basis for presentation of general purpose financial statements to ensure that the comparability of entities' financial statement of previous periods with that of the current period. That is the first objective of presenting the financial statement as per the INDAS 1. Even though it is mandatory, the purpose of presenting the financial statement, first one is in order to compare the financial statement of that company with the financial statement of the previous year. So the company can make sure what is the growth of the concern, or what is the progress status of the concern. These can be identified by comparing the financial statement of the current period with the preceding period. That is one purpose. And another one is INDAS 1 ensures the comparability of financial statement of the entity with that of the others. I believe we have discussed these 2 points in the last session or last module. The main purpose of presentation of financial statement as per INDAS 1 is, first one, comparability of the financial statement of the same company with its preceding years in order to identify the growth state or progress situation. And secondly, the presentation of financial statement as per INDAS 1 ensures the comparability of the financial statement of one company with the financial statement of other companies, so that we can compare how the performance of the companies is going on, whether one company is performing better than another, or they are going at the same level, or whatever it is. So INDAS 1 ensures these 2 main aspects. The objective of INDAS 1 is to prescribe the presentation of financial statement to ensure comparability both with the financial statement of the previous period and with the financial statement of other undertakings or other companies. It sets out the requirements for the presentation of financial statements, guidelines for their structure, and minimum requirement for their content. That are aspects of INDAS 1. Next one, financial statement. So let us go directly into how the financial statement is prepared. Earlier I have mentioned that financial statement is not a single statement or an account. It comprises of a set of statements. And when it comes to financial statement, you all know financial statement comprises of trading profit and loss account and balance sheet. But actually these items are there. Apart from that, there are some other statements that has to be prepared in order to make the financial statement complete. So financial statements are a structured representation of the financial position and financial performance of an undertaking. The objective of financial statement is to provide information about the financial position, financial performance, and cash flows. That is another important concept. What is the flow of cash in the organization? So which is useful to a wide range of users in making decisions. So that is the main purpose of presenting or preparation of financial statement, in order to identify the financial performance, financial position, and cash flows. Financial statement also show the results of management's utilization of resources. How the management is, the resources of a concern is very scarce or very rare, and how the management is efficiently utilizing, or how the company is maintaining an optimum utilization of its scarce resources, and the users are very likely to know what is the actions taken by the concern in maintaining the optimum utilization of resources. So in order to identify the financial performance or financial position or cash flows, or how the management is effectively utilizing the resources, in order to identify all these, we are presenting the financial statement in such a manner. The statement comprises of, first one, balance sheet at the end of the period. We can simply say balance sheet. We have prepared that because in the trading profit and loss account and balance sheet, we have prepared the balance sheet by the end. So a balance sheet at the end of the period, and end of the period means end of the financial year. An income statement. you might know the term profit and loss account. In the INDA standard, it will be mentioned as income statement. Simply means profit and loss. So, an income statement or a statement of profit and loss account for the period. Next one, statement of changes in equity for the period. You might be hearing this item for the first time. Why this statement is prepared is that we know the main pillar of every business is capital. We need capital to conduct business. So, the other term of capital means equity. Capital is actually a narrow concept term and equity is a broader concept term. Equity comprises of capital and other earnings of the share owners or shareholders. Anyway, from this module onwards, we will be using the term equity instead of capital, because equity is a standard word when compared to a capital term. So it is better to use equity rather than capital. Don't get confused with equity and capital. Equity is a broader sense word and capital is a narrow sense word. That is the difference. So, in the statement of changes in equity, during the period there will be opening capital and by the end there will be closing capital, and during the year there might be additions. So, the change in the position of the capital is of great importance in identifying the performance as well as position. So we need to identify what are the changes that occurred in the capital amount or in the equity amount. So statement of changes in equity is another statement that is prepared to identify the flow of capital within the organization during a specific financial year. So we have to prepare that one, and we will learn how to prepare a statement of changes in equity. Next one, statement of cash flows for the period. It depicts what are the cash inflows and what are the cash outflows during the period. Cash inflows mean what are the sources from which the company has collected money, and cash outflows means what are the application areas in which the company had spent their money. You may think that we can easily identify these from the cash book, but cash book only depicts the sources and applications, and finally you can identify the balance that is left after by the end of the period. But cash book has one issue. It doesn't mention what are the reasons for the sources or what are the reasons for the application. It doesn't give any information like that. But the statement of cash flow gives us a clear picture or gives us a clear idea about what are the sources from which we have earned money and what are the applications in which the company has spent their money. If there is any change in any of these sources or if there is any change in the applications during the period, all these information can be identified in the cash flow. In simple sense, we can say in cash book we can know only the closing balance, what is the cash balance at the end of the period. But in a statement of cash flow, it gives a clear idea about how the cash balance is maintained in the business. Is it because of the various sources or is it because of the minimum spending? It will mention the reason for the cash balance. That is the main difference between cash book and statement of cash flow. So here you have to prepare a statement of cash flows. And finally, notes. Notes means if there is any special policies are followed in the preparation or presentation of financial statement, it will be duly noted by the end of the statement. And comparative information in respect of the preceding year. Preceding period means if we are comparing the financial statement of the current period with any of the financial statement of the preceding period, the such comparative informations may be presented. So these are the contents of the presentation of a financial statement. So financial statement is not a single statement, it comprises of all these items. When you prepare all these items, we can say that you have presented the financial aspect or financial aspects of a concern as per the INDA is one. So next one, balance sheet as at the beginning of the preceding period when an entity applies an accounting policy retrospectively or makes a retrospective statement of items in its financial statement, or when it reclassifies items in the financial statement. We will discuss about that area by the end of the module, because then only you will get the understanding about what is the meaning of that sentence. Anyway, our financial statement comprises of all these items. We will discuss in detail the rest of the aspects. So next one, scope. IND-AS 1 applies in preparing and presenting general purpose financial statement. Other IND-AS set out recognition, measurement and disclosure requirement of specific transactions and events. Next one, IND-AS 1 prescribes the basis for presentation of financial statements to ensure comparability both with the entity's own financial statement of the previous period and the financial statement of other entities or companies. I am not going to explain this point again because we have gone through all these points. So, scope means what are the importance of using the IND-AS 1. Next one, key principles. Sometimes you may come across a question like that. You give a brief account of the basic features or general features of a financial statement. In some cases, you may come across a question like briefly explain the key principles of presentation of financial statement as per IND-AS. Whatever the type of question, anyway, when you come across, you are asked to find or you are asked to give an explanation regarding the principles or the general features of a financial statement, you have to pinpoint all these points. Anyway, let us go through these points individually. First one, true and fair view. If you are a commerce student, I know what is the meaning of true and fair view. We all know what is the meaning of true and fair view. Financial statement shall present true and fair view of the financial position and financial performance and also the cash flows. So from this module onwards, we will be studying financial state performance, financial position and cash flows. True and fair presentation can be achieved by faithful presentation, making explicit and unreserved statement compliances with accounting standards. Selection of correct accounting policies, presentation of the statements in a true and fair manner ensures the true and fair view of the transparent financial statement of the concern. It ensures transparency. That is the main concept. Second one, compliance with IND-AS. We all know what is meant by compliance with IND-AS. Compliance with IND-AS means IND-AS 1 prescribes about the presentation of financial statement, and the companies who are presenting their financial statement has to go through the rules and regulations set by IND-AS. So we are going with the rules and regulations set by the IND-AS. Next one, going concern. You might have heard the term going concern in your plus one class because going concern represents one of the main concept of accounting. And by going concern, I believe you all know what is meant by going concern. Every concern is initiated or started with the ultimate objective of running for an indefinite period of time. Unless if some companies have been started with the objective of closing their business or winding up their business after 5 years or 1 year, this concept doesn't matter. But in majority of the cases, we all conduct business or we all start business or company or a firm or an entity with the ultimate objective of working for an indefinite period of time. That is known as going concern concept. So companies started with the ultimate objective of going concern concept should also follow the IND-AS 1. Not only IND-AS 1, it has to follow as per the IND-AS standards. Next one, accrual basis of accounting. We all know what is meant by accrual basis. It is one of the main basic concept for preparing or recording the transaction in the financial statement. An entity shall prepare its financial statement except for cash flow information using the accrual basis of accounting. When the accrual basis of accounting is used, an entity recognizes item as assets or a liability or equity or income and expense when they satisfy the definition and recognition criteria for those elements in the framework. We know what is meant by assets, what is meant by liability, income and expense, and finally equity. We have learned about the key elements of a financial statement, how it is defined, how it is identified, how it is recognized. We have learned them in detail, all these aspects in the last module, and the accrual basis of accounting specifies the importance of the key elements in the financial statement. Next one, materiality and aggregation. The entity shall present separately each material class of similar items, and entity shall present separately items of dissimilar nature of function unless they are immaterial except when required by law. You have learned about the materiality principle in the accounting at the beginning of your plus 1 classes. That is the main concept of materiality and aggregation. If you have any queries, please go through the. Anyway, don't forget, before you go to study the 5th module, kindly go through the accounting concepts and accounting convention, or we can say accounting basics and accounting rules or principles. Go through all those concepts and principles, because in the theoretical aspect we will be discussing about various concepts and principles. Next one, offsetting. An entity shall not offset asset and liability or income and expense unless required or permitted by an INDAS. Offsetting means setting aside without recording for due to some reasons. An entity reports separately both assets and liabilities and income and expenses. Offsetting in the statement of profit and loss account or balance sheet, except when offsetting reflects the substance of the transaction or other events. So by the word meaning of offsetting means if some of the items are not recorded in the financial statement due to some reasons, it should be supported by a valid reason that might be specified in the INDAS. Without that, we can't set aside any key elements of a financial statement. That is the concept of offsetting. Next one, frequency of reporting. We all know the financial statement is prepared to provide reports to the management so that the management can take correct decisions. That is one of the purpose of presenting financial statement. So an entity shall present a complete set of financial statements at least annually. We all used to prepare annual reports, but nowadays not only the annual reports are prepared, interim reports also is preparing, because within 2 annual reports there are many reports. You might have heard the quarterly reports or half yearly reports with regard to any insurance companies or banking companies or private companies like that. Anyway, the company must prepare an annual report. When an entity changes the end of its reporting period and presents a financial statement for a period longer or shorter than 1 year, an entity shall disclose in addition to the period covered by the financial statement why they have selected or why the period of presenting the financial statement has taken a long time, or if it is less than 1 year, if it is a shorter period, why it has taken a shorter period. The company must specify the reason for that. Not only that, the facts and the amount presented in the financial statements are not entirely comparable. So in that case also, the company who is preparing the financial statement should provide solid reasons. Next one, comparative information. We all know what is meant by comparative information. We are not going further into that, because comparison means there are 2 types of comparison: comparing the financial statement of a company of the current period with the financial statement of the same company of the previous year periods. That is one sort of comparison. Another sort of comparison means comparing the financial statement of a company with the financial statement of another company. So these 2 types of comparison usually occur in case of accounting. And INDAS has specified various rules and regulations regarding the comparison of financial statement. Comparison may occur between balance sheet, comparing the balance sheet of one concern with another concern, or the balance sheet of same company with any of the financial previous balance sheet dates. It not only with regard to balance sheet, they will compare profit and loss, or they compare the trading accounts, they might compare the cash flows or statement of changes in equity or any other statements prepared under financial statement. These are compared under the comparative information concept. And finally, consistency in the presentation. Consistency means maintaining a regularity. If the company is following a certain pattern for presenting the financial statement, it should maintain that pattern for the coming years or for the subsequent years. So an entity shall retain the presentation and classification of its items in the financial statement from one period to the next. and to the subsequent years. They can't simply change the pattern in 1 year and the next year they are following a completely different pattern. Even though they are complying with the INDAS, they can't simply change the pattern in each year. So the company should maintain consistency, and INDAS ensures that consistency in the presentation of financial statement. So these are the key principles with regard to presentation of financial statement as per INDAS 1. Next one, key gap to be followed while preparing financial statement. So when you come across such a question, what will be your answer? Kindly specify or briefly explain the key gap to be followed while preparing financial statement. So the meaning of this question is, what are the basic accounting concepts and basic accounting principles that has to be followed while preparing a financial statement? We have learned about the accounting concepts and conventions in your plus 1 classes. So when you come across such a question, try to point out all those concepts and conventions. Even though in the question they are specifying only the principles, because GAP means generally accepted accounting principles, try to note down the concepts also. So when you come across such a question, give the complete details about the accounting concepts and conventions. Conventions means principles. Next one, general features of financial statement. Earlier I have mentioned that when you come across a question, what are the general features of a financial statement, or what are the key principles of financial statement complying as per the INDAS 1, the answer remains the same. We have discussed about all these points: true and fair presentation, going concern, accrual basis, materiality and aggregation, offsetting, frequency of reporting, comparative information, and consistency of presentation. So when you come across these type of question, the answer remains the same. So I believe you will deal those questions cautiously. Next one, structure and contents of a financial statement. The following information should be displayed prominently, and when it is necessary, be repeated for a proper understanding of the information presented. First one, name of the reporting entity and any change from the preceding reporting period. That is the first one you have to present. Actually, the structure and contents of financial statement means how the title and the general aspects of a financial statement comprises, or how it is presented. We all know it consists of the statements which we have learned in the last slide, but for each statement there will be a title. Whether it is relating to one company or two or more companies combined together, what is the date that has to be shown, what is the currency in which it has to be presented. So such kinds of information has to be mentioned here. That is the meaning of structure and contents of financial statement. Don't get confused with the statement which you have to prepare. We already mentioned that. Here we will discuss about the main general aspects like the title, currency, date of presentation, number of companies, such information. So first one, name of the reporting entity and any change from the preceding reporting period. That is as per the theoretical aspect. From your point of view or from the examination point of view, you have to specify the name of the company in the title of the statement. That is very important. You can't simply write down a statement without the name of the company, or without giving that name of the company as a title. So remember to give the name of the company. Next one, whether the financial information covers individual entity or a group of entities. Sometimes you are preparing the financial statement of one company like L and Sri Murugan Private Limited, or Kerala State Cooperative Union Limited, like that. Sometimes you may prepare the financial statement of more than one companies, just like joint ventures or a parent subsidiary company. But in actual practice, you need not have to worry about, because from the examination point of view, there is no much of a difference between the financial statement of an entity and group of entity, because you will be asked to prepare a financial statement. So don't worry about the individual entity or group of entity. Actually, in real practice, the presentation of financial statement of individual entity and group of entity is quite different From the syllabus point of view, you need not have to worry about the individual entity or a group entity. You will be given some details. On the basis of those details, you have to present the financial statement. So, for the theoretical aspect, remember that. First one, title. Next one, how many concerns are there, whether it is relating to one company or more than one company. Next one, date of reporting period end. Period covered by the set of financial statements and notes. That is very important. Next one, presentation currency. Since we are working in a global life system, our companies might be conducting their business in our country. Not only in our country, it will be operating in the foreign countries also. So the financial statement has to be prepared in the prevailing currency rates. So what is the currency that is following or presenting, and how the statement is presented as per the currency prevailing in that country. So anyway, the currency that is to be presented in the financial statement, it has to be noted. And finally, level of rounding off used in the presenting financial statement. Rounding off means whenever you come across a decimal value, how we are going to round the decimal. We all know how to round a decimal. So that is the concept. The level of rounding off used in the presenting financial statement. For each concern, they may be following a certain pattern of rounding. So what is the pattern used, and it should be mentioned in the financial statement. Next one, INDAS 1, details for presentation of financial statement. We already mentioned that. Anyway, we will discuss here about the correct title of each of these statements. We have mentioned that there is balance sheet had to be prepared at the end of the period. There will be a statement representing the changes in equity, but there is a specific title for each of these statements. We will discuss that. First one, we all know balance sheet, but from our syllabus point of view, or from the INDAS 1 point of view, you will have to write the title Statement of Financial Position, or SOFP. Here paragraph 5480 means INDAS 1. It consists of many theoretical aspects. In paragraph 54 and 80, from 54 to 80, significantly specifies how the balance sheet has to be prepared and the title of the statement, and all such related information will be specified in the paragraphs 54 to 80. So instead of balance sheet, you have to give the title Statement of Financial Position, and there is abbreviation SOFP. That is one. Next one, Statement of Profit and Loss. We all know profit and loss. It is written as SOPL. Instead of profit and loss account, you will write Statement of Profit and Loss, SOPL. It is also mentioned in paragraph 81A to 102. These are for the additional information. Next one, Statement of Changes in Equity, otherwise known as SOCE. Kindly remember these abbreviations. And the details of the Statement of Changes in Equity will be specifically mentioned in the paragraph 106 to 110 in the INDAS 1, Presentation of Financial Statements. Next one, Statement of Cash Flows, otherwise known as SOCF. It will be mentioned in the paragraph 111. And finally, other important notes or summaries that has to be prescribed whenever there is a change in the accounting policies or practices or any methodology used in the presentation of financial statements. It should be given in as an additional information under the head notes. The details of the contents of the notes and what are the procedures that has to be followed while presenting the notes is specifically mentioned in the paragraph 112 and 1 to 138. So these are the contents of a presentation of financial statement. We will, in this module, we will discuss in detail each of these statements individually, and we have to deal with some of the practical cases along with adjustments for each of these individual cases. So by the end, a financial statement of a company or a corporate concern that is complying as per the INDAS consists of all these items. So these are some of the theoretical aspects with regard to the INDAS compliant financial statements of the companies. And from the next session onward, we will directly jump on to the problem area. So before going to directly to problem area, you have to have a detailed idea about each of these statements. What is meant by SOFP, what is meant by SOPL, SOCE, SOCF. Since you have learned about all these aspects in your plus one classes, because you know how to prepare trading account, how to prepare a profit and loss account, how to prepare a balance sheet. All these you have learned in advance. So there is only some general aspect that has to be kept in mind in addition to the rules and regulation which you have learned. Don't worry, we will leave that. For each of these cases there is a format that is prescribed as per the INDAS, and we will learn in detail each of these formats, and you need to learn those formats very well, because if you know the format you can easily answer the question. If you don't know the format, I am sure that you won't be able to deal any of the essay questions with this module. So kindly, from the next sessions onward, we will deal with the formats of each of these cases, and we will learn about in detail each of these cases in the next sessions. So until then, go through these theoretical aspects with regard to this presentation of financial statement as per INDAS. If you have any queries with regard to any of these areas, please do let me know.